We're going to start off from the absolute basics. Okay, so we're going to go in further depth of understanding how to listen to Jerome Powell speak when he talks about interest rates or potential future interest rates. Is he hawkish? Is he dovish? Are we expecting cuts? Are we not expecting cuts? Are we expecting hikes? Whatever the case might be, and how it affects an economy. Okay, so obviously technical analysis is important by focusing on price action. We're looking for good entries or for value areas. But broad macro is the language of the wealth. It's the language of the elite. And it's essential to be following it, especially as a day trader, but more especially as a portfolio manager. Okay, so let's do a quick macro talk here, and I'll show a couple examples too. So this is in alignment with the US, where we have the Fed, and South Africa, it's called the South African Reserve Bank. But just to do the absolute basis here, so interest rates is the cost of borrowing money. So why is this important? If the interest rates are low, then it's going to influence businesses to be taking out more loans and keep money circulating through the economy. Okay, it increases consumer spending. So when interest rates are high, then obviously businesses and consumers are taking out less loans, and for that case, they are more, tight when it comes to their spending. So this is going to be very, very important. Inflation, rising prices of goods and services in an economy. Pretty simple. You buy something for $2 today. In 2 years' time, it's not $2 anymore. It's $3, for example. So now, this is where monetary policy and fiscal policy come into play. The difference between the two is monetary policy is the central bank. Okay? Fiscal policy is the government that controls fiscal policy. So fiscal policy, the government, parliament, Congress, whatever you want to call it, they control the fiscal policy, and the central bank in itself controls the monetary policy. Okay, so how does the central bank control the monetary policy? They control the money supply by either printing more or restricting it. They do things like quantitative easing and tightening, which we'll get into a whole nother video. And then more importantly, they control interest rates. Okay, so they're either rising interest rates or they're cutting interest rates. So the goal here is to control inflation, stabilize the currency, manage economic growth, and maintain financial stability for the economy. Okay, if inflation is high, the central bank may rise interest rates to make borrowing more expensive and slow consumer spending. So when inflation is high, prices of goods and services are going high. Obviously, there's a more demand for something, there's more spending, so prices are increasing. The central bank may raise interest rates, so it's going to make borrowing more expensive, and that indirectly is going to be slowing the consumer spending from businesses and the general public. Okay, so we'll get more into that now. Fiscal policy, obviously the government is in control of fiscal policy. Essentially what they're doing is they're focusing on things like taxation, and of course, government spending. So like infrastructure, social programs, but mainly taxation is what's going to be important here. So the goal for fiscal policy is to influence overall demand, creating jobs, stimulating or slowing down the economy. Okay, so for example, in the case of a recession, the government may cut taxes and increase spending to boost demand and create more jobs. So I'm going to show you how this all adds up and leads together. So that's the main thing you need to understand. Fiscal policy is the government, and they can control taxation, and monetary policy is the central bank, and they're controlling things like interest rates. Okay, interest rates is the cost of borrowing money, and inflation is the rising price of goods and services. If the cost of borrowing money is cheap, it's going to influence more spending. If it's expensive to borrow money, it's obviously going to tighten spending. Okay, so the basic inverse relationship here. So interest rates, when interest rates go up, inflation comes down. Okay, so when interest rates go up, it's expensive to start borrowing money, so the price of goods and services are going to come down. Okay, it's like supply and demand. When interest rates are low, and it's cheap to be borrowing money, more businesses are taking out loans, more businesses are spending money, and that indirectly starts pushing the prices up. Okay, so it's not one-to-one effect, as I've stated here. There is often a lag. It's often 6 to 18 months, just based on research and good old friend ChatGPT giving us insights here. But very, very important, when interest rates are going up, inflation comes down, and when interest rates are low, inflation is likely to soar. Okay, so higher interest rates make borrowing more expensive, as we've stated, slowing consumer spending and business investments, which then lowers demand and less upward pressure on pricing. Okay, so think of it as supply and demand and the cost of what it's going to take to be borrowing money. When interest rates are super cheap, I'm going to be taking out some loans. I'm going to be stimulating the economy by splurging more of my cash. But if interest rates are high, I'm going to be keeping cash to myself. I don't want to be taking out loans and be paying high interest. Okay, so lower interest rates makes borrowing cheaper, encouraging spending and investment, higher the demand, and that puts more upward pressure on pricing, increasing inflation. Okay, so fairly simple. So this is how monetary policy affects this. Obviously, monetary policy, central bank taking actions to control money supply. Okay, so if inflation's too high, the central bank starts rising interest rates, reduces demands for loans, slows investment and spending, and inflation tends to fall, as we've said. We're going to go a little bit more into QE and QT in another video. And if inflation's too low and the economy is sluggish, then central banks will cut rates, making credit cheaper, which will boost spending, boosting investments, and inflation may rise towards target. And they might use something called QE, which is buying assets to inject liquidity, which we'll get into. So how fiscal policy plays a role is government decisions on spending and taxation. So there's two different types of fiscal policy: expansionary, contractionary. It's not super complex, but essentially expansionary is more government spending and tax cuts, where contractionary is more spending cuts and tax hikes. Okay, so expansionary increases the demand in the economy, can push inflation higher if the economy is already or near at capacity. Okay, if we can pair this with low interest rates, the inflationary effect is amplified. So now you can see how they work hand in hand here. Okay, contractionary fiscal policy, if there's tax hikes and spending cuts from the government, this reduces demand, can bring inflation down, especially if supported by high interest rates. Okay, so if the monetary policy is calling for higher interest rates, the government is calling for a contractionary fiscal policy, this can definitely help bring down inflation. Okay, so they need to be working hand in hand, and ideally are working hand in hand. Fiscal policy can work with monetary policy, or it can work against it. Okay, so if the central bank is rising interest rates to fight inflation, but the government increases spending aggressively, it can actually blunten the impact of higher interest rates. Okay, so they can sometimes work hand in hand and sometimes they don't. If both tend to tighten policy, so we get higher interest rates plus reduced spending, inflation can fall a whole lot faster, but so quickly it can fall at the rate to a point that we actually start getting put into a recession. Okay, so now in terms of like real world nuances and kind of how we can see it in the markets. Okay, so the correlation is stronger in demand driven inflation, too much money chasing too few goods. Okay, so in supply driven inflation, for example, oil shocks, global supply chain issues, higher interest rates still help over time by cooling the demand, but they can't directly fix the supply problem. Okay, so in that case, supply is still based on, public and private sector. Interest rates and fiscal policy and monetary policy don't affect the supply. But what they can do is they can put in certain measures in place that can influence the supply and demand chain, okay, affecting pricing by controlling the consumer spending. Okay, so they can't affect the supply, but they can affect the consumer spending. Okay, so policy decisions must balance inflation control with avoiding an economic crash. I mean, as we said here, if both fiscal and monetary are working together, if both tighten their policy, if we look for higher rates plus reduce spending, inflation can fall, but at a fast rate that we could actually lead into a recession. Okay, so that's a breakdown 101 here: monetary policy, fiscal policy, interest rates, inflation, how to utilize it, understanding it, basics. Interest rates go up, inflation comes down, interest rates go down, inflation goes up. And yeah, so that's the basics here. We'll get into QE and QT on the next one. We'll start understanding like dovish, hawkish, how to listen to the news, how to start getting some insights based on tonality of conversation by people like Jerome Powell, based on future potential rate cuts and how it affects our portfolio as a whole. Cool. See you in the next video. Cheers.